ParthKuchana.com, complete fundamental and technical analysis of stocks and other financial industry updates. Hello, welcome to Partha Kuchana Finance channel. This video provides complete fundamental analysis of HDFC Bank Ltd HDFC Bank stock. Disclaimer: this analysis is for educational purpose only. This is not financial or investment advice. Make financial and investment decisions on your own. Valuation. Let's focus on assessing return on capital, equity efficiency, overall pros and cons, and valuation and calculation of key ratios and interpret them. This is based on market cap, current price, high-low, ROCE, ROE, pay ratio, book value, face value, financial ratios data. Fundamental analysis. Return on capital employed, ROCE. HDFC Bank's ROCE stands at 7.67%. This ratio indicates how efficiently the bank is utilizing its capital to generate profits. A ROCE of 7.67% suggests a moderate level of efficiency in deploying capital, though it is relatively low compared to industry benchmarks. High ROCE values are typically preferred, especially in a sector like banking, where efficient use of capital is crucial. Return on equity, ROE. The ROE for HDFC Bank is 17.1%. This is a strong performance metric, reflecting the bank's ability to generate profits from shareholders' equity. Historically, the ROE has been consistent around 17%, which is robust and suggests efficient use of equity in generating returns. This level of ROE is generally considered favorable and indicates effective management and profitability. Price to earnings, PE, ratio. The PE ratio of 18.1x suggests that the stock is trading at 18.1 times its earnings per share. This is relatively moderate, indicating that the stock is neither undervalued nor overvalued based on current earnings. Comparing this with industry peers can provide further insight into valuation. A lower PE ratio might indicate undervaluation, while a higher PE could suggest overvaluation. Book value. The book value of HDFC Bank is 601 rupees. The current price of 1,616 rupees implies that the stock is trading at approximately 2.69 times its book value. This high multiple may indicate that the market has high expectations for future growth and profitability. It could also reflect the bank's strong brand, market position, and growth prospects. Face value. The face value of the stock is 1 rupee. This is a nominal value used primarily for accounting purposes and does not typically impact the stock's market performance directly. Pros. HDFC Bank has delivered impressive profit growth of 23.4% CAGR over the last 5 years, demonstrating strong financial performance and growth potential. The company maintains a healthy dividend payout ratio of 22.9%, providing consistent returns to shareholders. The bank has exhibited a median sales growth of 16.4% over the last decade, reflecting solid revenue expansion and market presence. Positive expectations for upcoming quarters indicate continued growth potential. Cons. The stock trades at 2.69 times its book value, which could suggest overvaluation relative to the book value. The bank has a low interest coverage ratio, which may indicate potential difficulties in meeting interest obligations or financial strain. Contingent liabilities amount to 24,09,821 crore rupees, representing significant potential future liabilities that could impact financial stability. A large portion of earnings includes other income of 1,49,943 crore rupees, which may raise concerns about the sustainability of earnings from core operations. Conclusion. HDFC Bank exhibits strong profitability metrics with a solid ROE and moderate PE ratio. However, the high trading multiple relative to book value and the low interest coverage ratio could raise concerns about valuation and financial risk. The consistent ROE and significant profit growth are positives, but the substantial contingent liabilities and reliance on other income warrant careful consideration. Overall, the bank's strong historical performance and growth prospects make it an attractive investment, but potential risks should be monitored closely. Financial health. Let us focus on financial health and leverage analysis. Review asset and liability management and equity changes. This is done focusing on assets, liabilities, equity, key metrics from the balance sheet over the last several quarters. Balance sheet analysis. Equity capital. Current amount 760 crores rupees. Analysis. Equity capital has increased steadily over the years, with a significant jump from 555 crores rupees in March 2022 to 760 crores rupees in March 2024. This growth reflects ongoing capital infusion, which could be due to new equity issues or retained earnings. This increase strengthens the bank's capital base, enhancing its ability to absorb shocks and fund growth. Reserves. Current amount 455,636 crores rupees. Analysis. Reserves have seen substantial growth from 246,772 crores rupees in March 2022 to 455,636 crores rupees in March 2024. This impressive increase indicates strong profitability and prudent reserve management, which can be used to cover potential losses or reinvest in business opportunities. Borrowings. Current amount 3,107,503 crores rupees. Analysis. Borrowings have significantly increased from 1,784,970 crores rupees in March 2021 to 3,107,503 crores rupees in March 2024. This rise suggests aggressive expansion or increased funding needs. While higher borrowings can indicate growth, they also require careful management to ensure that debt levels remain sustainable and do not overly strain the bank's financial health. Other liabilities. Current amount 466,296 crores rupees. Analysis. Other liabilities have risen sharply from 101,783 crores rupees in March 2022 to 466,296 crores rupees in March 2024. This substantial increase could reflect various factors, such as higher operational costs or deferred expenses. It is essential to investigate the nature of these liabilities to assess their impact on financial stability. Fixed assets. Current amount 12,604 crores rupees. Analysis. Fixed assets have grown from 6,432 crores rupees in March 2021 to 12,604 crores rupees in March 2024. This growth indicates ongoing investment in infrastructure or technology, which could support future operational efficiency and capacity expansion. Investments. Current amount 1,005,682 crores rupees. Analysis. Investments have nearly doubled from 449,264 crores rupees in March 2022 to 1,005,682 crores rupees in March 2024. This significant increase highlights a strategic focus on expanding investment portfolios, which could enhance returns and diversify income sources. Other assets. Current amount 3,011,909 crores rupees. Analysis. Other assets have grown from 2,010,419 crores rupees in March 2022 to 3,011,909 crores rupees in March 2024. This increase suggests substantial growth in various asset categories, possibly including cash, receivables, or intangible assets. Conclusion. The bank demonstrates robust financial health with increasing equity capital, substantial reserves, and a significant rise in investments. However, the sharp increase in borrowings and other liabilities warrants careful monitoring to ensure the bank's leverage remains manageable. Overall, the bank's asset and liability management appears sound, with a focus on growth and expansion balanced by increased capital and reserve strength. Cash flows from financing activities. Now let's look at the trend and interpretation of cash from operating activities, cash from investing activities, cash from financing activities, net cash flow. This is done focusing on cash flow data over the last several quarters. Cash flow analysis. Cash from operating activities. Trend, fluctuating results over the years with some negative values. Analysis. The cash flow from operating activities has shown significant volatility, ranging from -62,872 rupees crores in March 2019 to 42,476 crores rupees in March 2021, and then experiencing more fluctuations afterward. The recent figure of 19,069 crores rupees in March 2024 is positive but lower than the peak in 2021. This volatility suggests variability in operational efficiency or changes in working capital management. Cash from investing activities. Trend, generally negative with a sharp positive shift in March 2024. Analysis. The bank has consistently had negative cash flow from investing activities, indicating continuous investment in growth or acquisition activities. However, the substantial positive cash flow of 16,600 crores rupees in March 2024 suggests a possible divestment or reduced investment outflows, potentially improving liquidity. Cash from financing activities. Trend, mixed results with occasional large inflows and outflows. Analysis. The cash flow from financing activities shows a mix of inflows and outflows, with notable inflows in certain years, such as 57,378 crores rupees in March 2018 and outflows in others, like -7,321 rupees crores in March 2021. The negative figure of -3,983 rupees crores in March 2024 indicates a net outflow, possibly due to repayment of debt or dividend payments. Net cash flow. Trend, generally positive with some fluctuations. Analysis. Net cash flow has been positive for most years, peaking at 73,750 crores rupees in March 2018 and showing a positive trend of 31,687 crores rupees in March 2024. This consistent positive net cash flow indicates overall good liquidity and cash management. Pros and cons. Pros. Positive net cash flow in recent years suggests good liquidity and financial health. Substantial positive cash flow from investing activities in March 2024 indicates potential successful divestments or reduced capital expenditures. Cons. Volatility in cash from operating activities may point to operational inefficiencies or significant changes in working capital. Persistent negative cash flow from investing activities might suggest heavy investments that could impact liquidity. Conclusion. HDFC Bank demonstrates overall strong cash flow performance with positive net cash flow and improvements in investing cash flow. However, the volatility in cash from operating activities and the recent negative cash flow from financing activities warrant attention. Continued focus on stabilizing operating cash flow and managing financing activities will be crucial for maintaining robust financial health. Revenue trends, profit margins, expense management. Let us now focus on revenue trends such as growth or decline, seasonality. Profit margins, like gross profit margin, operating profit margin, net profit margin and expense management. Revenue trends. HDFC Bank has demonstrated consistent revenue growth over the years. From a revenue of 35,861 crores rupees in March 2013, the company has grown its revenue to 314,027 crores rupees in the TTM period. This growth reflects a robust expansion trajectory, with notable acceleration in recent years, particularly from FY 2022 onwards. Profit margins. Gross profit margin. The gross profit margin has shown stability. Although precise figures aren't available, the growth in revenue and financing profit indicates healthy margins. Operating profit margin. The operating margin has fluctuated, particularly with an increase in expenses and changes in interest and other incomes. The drop in margin to -16% in the latest period is a concern, suggesting increased pressure on operational efficiency. Net profit margin. The net profit margin has generally improved, reflecting an increase from 19% in FY 2013 to around 22% in the latest period. This improvement indicates enhanced profitability relative to revenue. Expense management. Operating expenses. Operating expenses have been on the rise, from 12,631 crores rupees in March 2013 to 208,507 crores rupees in the TTM period. Despite this, the revenue growth has outpaced expense growth, suggesting effective cost management overall. Cost of goods sold, COGS. Specific COGS figures aren't provided, but the overall expense trend indicates increased operational costs that have been managed well in terms of revenue generation. Earnings before interest and taxes, EBIT, and earnings per share, EPS. EBIT trends show strong growth from 10,004 crores rupees in March 2013 to 82,699 crores rupees in the TTM period, reflecting solid operational performance before interest and tax expenses. EPS has shown a significant upward trend from 14 rupees and 44 paise in FY 2013 to 89 rupees and 75 paise in the TTM period. This increase demonstrates a solid return on shareholder equity and improved profitability. Profitability ratios. Return on equity, RORO, has generally been strong, reflecting effective use of shareholder funds to generate profits. Return on assets, ROA. While specific ROA figures are not provided, the increase in net profit and EPS suggests that the company effectively utilizes its assets to generate earnings. Exceptional items and non-recurring costs. Impact of exceptional items. The significant drop in financing profit margins in recent periods and the large increase in expenses suggest there may be exceptional items or non-recurring costs impacting the latest figures. This needs further investigation for a complete picture. Impact on company stability. Revenue consistency. HDFC Bank shows strong revenue consistency with a clear upward trend, indicating stability and growth potential. Profitability analysis. The profitability has improved over time, though recent periods show increased expenses impacting margins. Overall, profit margins remain healthy relative to industry standards. Earnings trends. Earnings have consistently grown, demonstrating strong performance and the company's ability to generate increasing profits over time. Overall, HDFC Bank exhibits strong growth in revenue and earnings, though recent expense increases and margin fluctuations suggest a need for careful monitoring of operational costs and exceptional items. The company's ability to maintain profitability despite rising costs reflects its resilience and efficient management. Overall performance, growth trends, profitability, and operational efficiency. In this section, let us focus on highlighting overall performance, growth trends, profitability, and operational efficiency. Provide insights into the company's financial health and potential future outlook. This is done based in trends and growth, profitability and margins, operational efficiency, profit before and after tax, earnings per share, EPS, details from quarterly earnings reports over the past several quarters. Trends and growth. HDFC Bank has demonstrated consistent revenue growth over the quarters analyzed. Starting from 32,254 million rupees in June 2021, the revenue has steadily increased, reaching 81,546 million rupees by June 2024. This reflects a robust growth trajectory, with significant spikes observed in the most recent quarters, particularly a notable rise from 47,548 million rupees in March 2023 to 81,546 million rupees in June 2024. This substantial growth indicates a strong expansion in business operations and market penetration. Profitability and margins. The operating profit margins, OPM%, have experienced fluctuations with noticeable volatility. Initially, the margin was 12% in June 2021 but varied across subsequent quarters. The margin peaked at 17% in December 2022 before falling sharply to -34% by December 2023 and recovering slightly to -16% in June 2024. The decline in margins, particularly in the latter half of the period, suggests potential issues in cost management or increased operational costs affecting overall profitability. Operational efficiency. Operating profit trends show a positive initial trend with an increase from 3,962 million rupees in June 2021 to 7,815 million rupees in December 2022. However, there was a sharp decline to minus 27,196 million rupees by December 2023, indicating deteriorating operational efficiency or increased financial strain. Expenses also increased significantly, particularly noticeable in the last quarters, with expenses rising from 14,073 million rupees in June 2021 to 62,938 million rupees in December 2023. Depreciation was consistently zero throughout the analyzed period, implying that depreciation might not be a factor in operational inefficiency during these quarters. Profit before and after tax. Profit before tax has shown steady growth, increasing from 10,642 million rupees in June 2021 to 22,727 million rupees by June 2024. The net profit also demonstrated a positive trend, rising from 7,940 million rupee to 17,188 million rupee over the same period. However, the tax percentage varied, with a decrease from 25% in June 2021 to 24% in June 2024, with an unusual -1% tax rate in December 2023. The effective tax rates and their fluctuations impact net profitability. Earnings per share (EPS). EPS has generally increased, reflecting overall positive financial performance. From 14 rupees and 33 paise in June 2021, EPS climbed to 23 rupees and 20 paise by June 2024, indicating improved earnings attributed to shareholders. The peaks in EPS correspond to the higher net profits, demonstrating effective profit generation and shareholder value enhancement. Conclusion. Overall, HDFC Bank has shown strong revenue growth and positive EPS trends, indicating robust financial health. However, the volatility in operating profit margins and substantial fluctuations in operational efficiency and profitability metrics warrant closer scrutiny. The recent quarters have highlighted significant financial challenges, particularly affecting margins and operational efficiency. The company's ability to manage costs and sustain revenue growth will be critical in maintaining its financial stability and profitability in the future. Company stability and competitive positioning. In this section, focus is on current market price, price positioning, price to earnings ratio, PE, valuation comparison, growth expectations, market capitalization, size and stability, investor confidence, dividend yield, dividend %. Income generation, company strategy, net profit, profitability comparison, profit trends, quarterly profit variation, growth volatility performance trends, sales, revenue scale, revenue consistency, quarterly sales variation, sales growth, market trends, return on capital employed, ROCE %, efficiency and profitability comparative performance, compared to peers in the same industry. Comparative financial analysis of HDFC Bank and its peers. Current market price, CMP. HDFC Bank, 1,615 rupees and 75 paise. Analysis, HDFC Bank's CMP is higher compared to its peers, such as ICICI Bank, 1,172 rupees and 60 paise, and Axis Bank, 1,133 rupees and 50 paise, indicating a premium valuation. Kotak Mahindra Bank, 1,773 rupees and 65 paise, also has a higher CMP, but HDFC Bank's valuation is positioned competitively within the higher range of the market. Price to earnings ratio, PE. HDFC Bank, 18.06. Analysis. The PE ratio of HDFC Bank is slightly lower than that of Kotak Mahindra Bank, 18.91, and ICICI Bank, 18.21, but higher than Axis Bank, 13.11. This suggests that while HDFC Bank is valued reasonably, there may be slightly higher growth expectations or market confidence reflected in the PE ratios of its peers. Market capitalization, market cap. HDFC Bank, 12,30,796.49 crore rupees. Analysis: HDFC Bank has the highest market capitalization among its peers, significantly larger than ICICI Bank, 8,25,311.83 crore rupees, and Kotak Mahindra Bank, 3,52,592.98 crore rupees. This indicates a strong market position and higher investor confidence. Dividend yield: HDFC Bank, 1.21%. Analysis: HDFC Bank's dividend yield is comparable to its peers, with slightly higher yields observed in IndusInd Bank, 1.19%, and IDBI Bank, 1.59%. The lower yield reflects a focus on reinvesting profits rather than distributing them as dividends. Net profit, NPQTR. HDFC Bank, 17,188.05 crore rupees. Analysis: HDFC Bank's net profit is the highest among the peers, indicating strong profitability. It significantly surpasses ICICI Bank, 12,462.81 crore rupees, and Kotak Mahindra Bank, 7,448.16 crore rupees. Quarterly profit variation, QTR profit VAR %. HDFC Bank, 33.18%. Analysis: the high quarterly profit variation suggests HDFC Bank's profits are relatively volatile compared to peers. For instance, IDBI Bank shows a high variation of 41.09%, while Axis Bank has lower variation at 5.67%. This could reflect business cycle fluctuations or adjustments in financial strategies. Sales QTR. HDFC Bank, 81,546.20 crore rupees. Analysis: HDFC Bank leads in quarterly sales, ahead of ICICI Bank, 44,581.65 crore rupees, and Kotak Mahindra Bank, 15,836.79 crore rupees, reflecting its large-scale operations and market reach. Quarterly sales variation, QTR sales VAR %. HDFC Bank, 59.37%. Analysis: the high quarterly sales variation indicates dynamic sales performance. This is higher compared to peers like ICICI Bank, 20.15%, and Kotak Mahindra Bank, 23.06%, suggesting either rapid growth or variability in sales figures. Return on capital employed, ROCE. HDFC Bank, 7.67%. Analysis: HDFC Bank's ROCE is in line with its peers but slightly lower than IndusInd Bank, 8.42%, and Kotak Mahindra Bank, 7.86%. A higher ROCE for IndusInd and Kotak Mahindra may indicate better efficiency in capital utilization. Impact on company stability and competitive positioning. Strengths: HDFC Bank has the highest market cap and net profit, showcasing strong market dominance and profitability. Its CMP reflects high market confidence, and its scale of operations is superior to most peers. Weaknesses: the high quarterly profit and sales variation suggest potential volatility. The PE ratio, while competitive, is slightly lower compared to some peers, which may impact market perception of growth potential. Opportunities: leveraging its market position and profitability, HDFC Bank can focus on stabilizing its profit and sales variation to enhance investor confidence further. Risks: the high profit variation and relatively lower ROCE compared to some peers could indicate potential areas for improvement in operational efficiency and financial stability. Overall, HDFC Bank demonstrates strong financial performance with a prominent market position but should address the volatility in profits and sales to maintain its competitive edge. Changes in promoter, FIIs, DIIs, government, and public shareholding. In this final section, let us evaluate the company's ability to generate cash and manage its financial obligations. With focus on changes in promoter, FIIs, DIIs, government, and public shareholding with the objective of evaluating stability and investor confidence. Shareholder pattern analysis of HDFC Bank. 1. Promoter shareholding. Promoter shareholding has seen a gradual decline from 25.83% in September 2021 to 0 by June 2024. This significant reduction suggests that the promoters have divested their holdings completely or transferred their shares elsewhere. This could imply a strategic shift or exit by the founding or key insiders, which may impact investor confidence and the company's strategic direction. To foreign institutional investors, FIIs. FIIs have experienced fluctuations in their shareholding, decreasing from 38.23% in September 2021 to 47.17% in June 2024. Despite earlier declines, there is a notable rebound in their stake, which indicates renewed confidence from international investors. The increase in FII's shareholding is a positive sign of international investor interest and trust in the company's growth prospects. 3. Domestic institutional investors, DIIs. DII shareholding has increased significantly from 22.53% in September 2021 to 35.20% in June 2024. This rise reflects growing institutional confidence in HDFC Bank, suggesting strong support from domestic financial institutions. Increased DII investment is a positive indicator of the bank's financial health and potential for stability. 4. Government holdings. Government holdings have remained stable and minimal, fluctuating slightly from 0.16% to 0.18%. This consistent low level of government ownership indicates limited government involvement or interest in HDFC Bank, which is typical for private sector financial institutions. 5. Public shareholding. Public shareholding has varied, with an overall increase from 13.25% in September 2021 to 17.44% in June 2024. The increase in public shareholding suggests growing retail investor interest, which can enhance liquidity and market stability. However, the fluctuations in public holding might reflect changing retail sentiment or market conditions. 6. Other shareholders. The number of shareholders has increased from 15,98,813 in September 2021 to 36,64,325 in June 2024. This substantial rise indicates growing retail and small investor participation, which contributes to the liquidity and market depth of HDFC Bank's shares. Overall assessment. The shareholder pattern indicates significant changes, particularly with the complete exit of promoters and increased investment from FIIs and DIIs. While the promoter exit might raise questions about strategic continuity, the rise in institutional investments is a positive sign of confidence from large investors. The growth in public and overall shareholder numbers also suggests improving market interest and liquidity. Overall, HDFC Bank appears to be maintaining a strong position with increased institutional support and growing retail participation. Thank you for watching. If you like this analysis, please like, share and subscribe. Also, do not forget to visit parthakuchana.com.